Well, hello and welcome to this live webinar with WCM Investment Management. Joining me, Peter Switzer, is Paul Black. Paul is CEO and Portfolio Manager at WCM Investment Management, and he joins me live from WCM's Laguna Beach headquarters in California. Thanks for joining us, Paul.
Thank you, Peter. Great to be here.
Now, I've got to ask this question. Being at Laguna Beach, what's the surf like this morning?
You know, just like Australia, it's a perfect day, 6 to 7 feet, perfect curl, 72 degrees. I guess you guys use Celsius, right? So you'll have to translate that, but it's warm.
Okay, fantastic, mate. All right, so a reminder to everyone on the line that this is an interactive webinar. Please feel free to enter a question in the control panel on your screen, and we'll come to those in the second half of the session. WCM are the investment manager of the WCM Quality Global Growth Strategy. The strategy is available to Australian investors via a listed investment company, an exchange trade managed fund, and an unlisted managed fund. Today we're talking to Paul to learn what makes the WCM Quality Global Growth Strategy unique and to understand the secret behind their phenomenal, and it is a phenomenal, long-term track record. All right, Paul, let's kick off with, you explaining to us. Well, I think before we start, I've got some questions I definitely want to shoot to you. But just for people who don't know much about you, why don't you just give us a feel for what WCM actually stands for?
Well, WCM stands for really running portfolios of high-quality global growth businesses, obviously all over the world, and that's been our emphasis for the last 15 years. We manage about $33 billion US in those strategies, and everything that we do is geared towards exploiting inefficiencies in the market so that we can outperform not only the benchmarks or the indexes, but also our peer group. And we've done a pretty good job of doing that over the last 10 years or so.
Okay, you've got what a lot of people describe as an investment process that looks at corporate culture, and they say it's very unique the way that you do it. And you also look at the trajectory of the company's economic moat. And
right.
So obviously a lot of people listening will say, well, it sounds good, but I want Paul to explain it to me. And if you can, give us some examples of a company with a weak or a strong corporate culture, and give us examples of companies with an expanding or contracting economic moat.
Yeah, well, let's talk about economic moats for a second, because people might not be familiar with that term. Basically, a moat is a Warren Buffett reference to a competitive advantage. Every business that you want to invest in should have a competitive advantage that allows it to outperform its peers. And the way that Buffett put it is to reflect on, buying a company is like buying a castle, and that castle has a moat around it. And that moat's designed to protect the castle or the business from competitors. So when we talk about moats, we're really talking about competitive advantages. And obviously, the bigger the moat for most people, the more likely they are to be able to protect themselves from invaders. Now, from our perspective, what we have found is it's much more important to buy businesses where the competitive advantage or the economic moat is actually expanding or growing. The more you can invest in businesses where that moat is getting stronger over time, the higher the likelihood is that you're going to have a very, very good outcome going forward. We'll talk more about that in the future, but that's a really important part of the process, because most managers just look at really wide moat businesses. We look for businesses where the moat's growing. Secondarily, we focus on a corporation's culture as the key driver of that competitive advantage. Every business has a culture, right? Every business has a set of values that animate that business. And what we want to do is we want to find those businesses where the culture is aligned with the competitive advantage. And the more we can find that alignment between the culture and the values with the competitive advantage, the longer it is that we're probably going to hold that investment. And it's interesting, because most people on Wall Street, most people around the globe don't focus on these two things. So we've really got some inefficiencies that we can exploit over time.
Okay, so let's go to examples. Examples of a business you bought because you really liked the economic mode and it was expanding, or ones you might have dumped because the mode was shrinking and you thought they'll lose the competitive advantage. And then an example of corporate culture, company that you might have accepted or dumped because of corporate culture.
Sure. Let me give you a couple of examples. It's kind of fun to talk about because, remember, we're a large cap growth manager globally. And most large cap managers, what do they own? They own Apple, they own Google, they own Facebook, they own Amazon, right? Those are all very wide moat businesses, very strongly competitively advantaged. But if you ask the question, you kind of frame it a little differently, are those companies actually getting stronger vis-a-vis other people in their industry? To us, the answer is no. So, it's really important, that we think you focus on expanding modes. So where most growth managers own Google, Facebook, Amazon, and Apple, those are all names that we've recently sold over the last year because we could no longer make the case that they were actually getting stronger vis-a-vis their competitors. Now, when you talk about cultures, I think one of the great companies in our portfolio that you should be aware of in Australia is Costco. If any of you have been in a Costco, you see that it's a really compelling company. I'm not sure, Peter, if you have Sam's Clubs down there, which is the Walmart knockoff.
No.
But Costco is a company where it's performed extremely well over a long period of time. And if you ask, us, what is the reason that Costco has performed so much better financially than other people in that space, certainly in the retail side, our argument is clearly it has to do with culture. Because when you think about great retailers should be about having happy employees. The happier the employee in a retailer, the better the experience for you and me, the better our experience, the more we're going to spend. And if we spend more money, the shareholders ultimately will do really well. So when you look for, cultures that absolutely lead to stronger competitive advantages, Costco is one of the ones at the top of the heap. And that's a name that you should expect us to own for a long period of time.
Yeah, Paul, I remember reading a story about the founder of Costco, and he kind of just had like a very simple desk, and he sort of sat amongst his employees, and he gave them Christmas pay rises. It was a story of it was totally unlike the CEOs of big retail outlets.
No, you're absolutely right. Costco is one of the largest, companies in America, and you have the founder of Costco, who, if you looked at most, certainly U.S.-based companies, most U.S.-based companies, the CEOs are making what, 15, 20, $25 million. Jim Sinegal, the founder of Costco, never paid himself more than $300,000 a year. Now, he owned a lot of stock, as he should, but the reality is when you set the tone from the top by paying yourself $300,000 versus, people on the floor who are servicing the client, probably making $60,000, $70,000, $80,000, that sends a very powerful message to the rank and file and the staff that they want to get with it and they want to help everybody win. So he's not trying to just milk the company of a lot of profits. He's trying to build a culture that's sustainable, that will reward shareholders for long periods of time.
Is there a company that you have held, but because of cultural changes, you thought, no, we can't keep holding this company?
A big red flag for us would be owning a company in the past like Reckitt Benckiser, which is a company that makes household goods and consumer goods. We own the company, and then in a very short period of time, both the CEO and the CFO resigned from the organization. To us, that's a huge red flag. When you have people that have been around for a long period of time and then in a short period of time, both the leaders of the firm leave, that's a red flag, and that's a company that typically we're going to move away from. But there are also, there are a lot of toxic cultures. I would go back to the U.S. and Dell. Years ago, dominant company in the enterprise space for computers, but a fairly toxic culture that ultimately led to its demise because they didn't change with the times and move on to what was going on in the cloud. So culture is really important, in terms of determining where the company goes.
Okay, let's have a look at the portfolio return. The one I've got here is 17.5% in the 12 months to February 2019, outperforming the benchmark by over 8%. Now, that is a very impressive number. How did you manage such a strong result in such a volatile environment without going to cash?
Yeah, it's a great question. It was a very, very rewarding year for our investors last year, and our argument always is that in difficult markets or in tough markets or even good markets, owning businesses, as we talked about earlier, where the moat's expanding, if you get that part of the equation right, in terms of the expansion of the competitive advantage, and also the alignment of the culture around it, you're probably going to have a pretty good outcome over time. So, it's interesting. Good year last year, but some of the years that we're the most proud of are like 2008, 2010, 2011, when the markets were actually down, and 2 of those years we were actually positive. And in all 3 years, we significantly outperformed the market, as you can see on the graph there. So this portfolio, it's interesting. This portfolio had a great year last year, but recognize that even though it's a stock portfolio in a global growth portfolio, it is built to really protect your assets in difficult markets. You can see on the top left of the graph, we only capture about 59% of the market when it's down. And the beauty of that is, obviously, most of the time the market goes up, and if you only go down 59% versus the market, you don't have to make up as much in the up years. And again, we're all about preserving assets for people, but giving you good compound returns over time.
Let's look at a company called Amazon, which a lot of people have heard of. And it's been one of the top performing stocks over the past few years, but recently you sold out of your position. Can you tell us why?
Yeah, let me just give you a little background on Amazon. If you bought, let's just say in 2007, you put $60,000 into Amazon. You decided, look, I like Amazon in 2007. You put $60,000 and made an investment in Amazon. That investment today, as of today, would be worth $1.8 million, right? A $60,000 investment in Amazon roughly 10 years ago worth $1.8 million today. Not bad, right? So who would sell that? Who in their right mind would sell that? Is there a growth manager in the world who is going to sell Amazon right now after those kind of returns? And we would say yes, there's one right here in Laguna Beach, California. Our argument is Amazon's a great business. It has a huge competitive advantage. But if you stop and ask the question differently, like we always do, does Amazon have the ability to grow its competitive advantage from here vis-a-vis everyone else in its space? To us, the answer is a resounding no. We actually find it interesting that a lot of value managers now are trying to make the case that Amazon is a value play. Right? 10 years ago, everyone thought it was extraordinarily rich and expensive. Now you've got value managers who are trying to make the case that it's a cheap company. Well, you know what? When we hear those words and when we hear value guys starting to, anchor on valuation, to us, it's usually a sign that the great growth days are not ahead of it, and it's probably a good time to pull aside. So as I said earlier, Peter, again, the names that have really helped portfolios, Google, Amazon, Facebook, and Apple, they don't exist in our portfolio. It's a very different portfolio today going forward than it was even 5 years ago. And we think that's how you create wealth for investors.
You obviously look at Amazon and say that moat is not going to expand and it could arguably be contracting. Do you have a cultural take on Amazon as well?
Love the culture. Love the culture because what Bezos was all about from day one was thinking in terms of 7 and 10-year time frames versus thinking in terms of 1 and 2 year time frames or even quarters. Yeah, love the culture, love the idea that Bezos thinks long term in terms of investing, but we don't think at this point in time that the total addressable market for Amazon is as positive as it was 10 years ago. So we'll step aside. And by the way, what's Amazon now? $1 trillion company? What are the probabilities that they're going to go to 2 trillion before, let's say, a company like Netflix goes from 20 billion to 40 billion? We'd rather own a smaller company that has a greater likelihood of growing significantly.
Okay, well, that's my next question, because you have recently added Netflix to your portfolio. Why do you like the company?
Well, it struck me, it's interesting. I have a brother-in-law who lives in Turkey. And, if you ask him, hey, is Amazon in Turkey? He will say, no, Amazon's not in Turkey because nobody can trust the logistics. Nobody can trust whether the package that needs to be delivered is actually going to be delivered to the door, right? And even if it's delivered to the door, they're not sure it's going to be there when they get home. And that's true in Brazil. That's true in Indonesia. That's true in a lot of countries that Amazon's trying to expand in. But if you ask them, tell me about Netflix, which is what, a $8.95, $10 a month charge. Do you know in like say Turkey or Brazil, you can stream just released movies in the theater for free because they bootleg everything? So you can get free copies of the most recently released movie in the theater, and people still spend money on Netflix at $10 a month. Why? Because they get a much higher quality experience. It's not a lot of money, and they get an incredible amount of new content. So when we started looking at Amazon versus Netflix as they expand outside the US, to us it was pretty clear that Netflix has a much greater runway going forward in emerging economies and other developed markets than we thought Amazon had. So we thought, bigger total addressable market for Netflix, probably a very compelling valuation, something great culture that really cares about its people, probably a good place to be.
Yeah, and I guess it's fair to say that when you stay home watching Netflix in these countries that you talked about, less chance of being mugged in your own home.
That's right. That's right. Now, here's the question. Here's the question, Peter. Now, the only question I have is, can you find The Castle on Netflix streaming?
I'll look into it for you. I'd be surprised if it's not there. It's such a great film, and
it's a great film.
Yeah, classic. The world should see what the average Australian's like. The Castle.
Yes, exactly.
Okay, mate. I've got one more question before we go to some of the questions that have already been sent to us. What sectors are you overweight at the moment, and why?
We continue to be overweight consumer sectors, the healthcare sector, and the technology sector, primarily because we believe that most of the growth going forward is going to come from the companies in these particular industries. We've said it many times, but it's very clear that around the globe, people are getting wealthier. People are entering the middle class in places like Brazil and Indonesia and India and China. And if you want a really interesting way to invest in those phenomenons, one of the ways to do it is to own the companies where people will spend money on their products as they get wealthier. So as people in Brazil and Indonesia get wealthier, they're going to demand higher quality consumer goods. We like those. They're going to spend more money on healthcare. We like that area. And they're going to spend a lot more money on technology. So the beauty of owning those areas and those sectors and being overweight those sectors is that just happens to be where the world is going. And as people spend more money on the products of the companies that we own, it should continue to drive growth for a lot of years to come. So we think this is a 10 to 15 to 20 year phenomenon going forward.
And when you say consumer goods, Paul, you are kind of implying some of the most well-known brands in the world, aren't you?
Absolutely. Brands that everybody knows, that have a huge competitive advantage. Luxury brands like Louis Vuitton, we would even probably put consumer names like a Costco in there. Just names that everybody knows that we think will dominate for a lot of years to come.
Okay, next question. Talk to us about Tencent. I noticed that one of your top holdings was Tencent. What is the culture like there?
It's interesting. That's a good question, because Tencent, we've wrestled with what the culture's like there, and we actually had a number of people, in their office, analysts from our office in their office, talking to the CEO and the CFO, trying to ferret out what animates that business. And it's interesting. What really we determined was very simple. What animates that business is they care about the user experience. Everything they do is to reward employees for creating a terrific user experience. Now, they're basically they're a big internet company in China. It's almost like owning Facebook, Google, and Amazon in one company. Very powerful. And to hear from the people running the organization that they care about the users, like Amazon cares about the customer, is music to our ears. Because if you're oriented that way, you're going to build everything into your business in order to capitalize on creating a perfect experience for the users, which ultimately will translate down into the shareholders.
I shouldn't make the point, but these are the questions that have been sent to us, so these aren't mine. That's why I'm looking down and reading them. What does the downside capture actually mean? So you showed a chart earlier, and one of our viewers wants to know, what does downside capture actually mean?
Downside capture essentially describes how we perform when the market is down. So let's say, for the sake of argument, that in 2018 the market was down 10%. By showing a number of 59% means that we only were down 5.9%. Now you might say, well, boy, I can't eat relative returns. I'm still down 5.9%. But the reality is, if you're a long-term investor, most of the time the market goes up, and over time you're going to compound those returns really well. So the key is never to lose more than the market when the market's down. So market's down 10%. Historically, we've only been down 5.9%. That is an enormous spread, an enormous difference, because, as I said, arguably most times the market's up. So over long periods of time, lose less than the downside, do well in the upside. You're going to have really good returns over a 10-year pull.
Okay. Here's another question, mate. I've heard WCM talk about picks and shovels companies. What do you mean by this, and what are examples in your portfolio today?
Yeah, an example would be, historically would be Sysmex, a picks and shovel company. When you think, we usually speak of it in terms of healthcare. So a picks and shovel company would be a company in healthcare that kind of builds the basic ingredients for providing healthcare over time. So, instead of buying a biotechnology company or a pharmaceutical company where you've got to make a bet on somebody getting a new prescription approved, by owning companies, let's say, that manufacture hips or manufacture knees or maybe make blood plasma, those are kind of essential ingredients to providing healthcare at all levels of society. So we love these kind of essential companies in healthcare that allow practitioners to do a better job at what they do every day. So a picks and shovel company, it came from obviously the gold rush in California in 1848, when you could either go hunting for gold, or you could sell the picks and the shovels to the gold miners. What's a more profitable way to do it? Well, you know what? If you want consistent returns, sell the shovels and the picks to the gold miners. Let them try to find the big find. So we'd rather get a much more consistent rate of return by selling picks and shovels to the people going for the big wins.
Okay. Here's another question for you, Paul. There's talk about the bond market predicting the recession is coming. How does your portfolio respond to things like a recession? And does your downside capture actually show that you guys do better even in bad times?
Yeah, it shows that we do better in bad times for sure. And in terms of worrying about the next recession. Now, Peter, when was the last time Australia had a recession? Like 40 years ago?
It was 28 years ago, mate.
28 years ago. It's unbelievable, right? So if you're looking for the boogeyman behind every tree all the time, you're never going to invest. And it's really interesting. We have a lot of so-called experts on the TVs here that are always calling for the next great recession. And inevitably, what we have found is the best thing to do is to position your portfolio to be there for a 10-year pull. People that make prognostications on where interest rates are going, what GDP growth is going to be, what the Fed's going to do, are almost inevitably wrong. And the people that make money, think about people that that have extraordinary amounts of money. How did they make it? You know what they did? They invested in a few small businesses or large businesses. They held them for decades, and they made a lot of wealth. The only people that make money by predicting the next recession are the talking heads on CNBC in the US and the people who are brokers that make transactions. So we stay away from that because nobody can get it right.
Yeah.
I've got so many great examples on it.
Yeah. Well, here's another question. How many stocks do you hold generally in your portfolio? And is there a number that you guys prefer to hold?
Yeah, we own we want to own between 30 and 40, and we own right now about 35 names in the portfolio. Definitely don't want to be over 40 names, because we want to stay focused on our best ideas. We're much more interested in putting more money in some of our better ideas than we are, trying to diversify the portfolio into 40 or 50 names. Again, some basics in the money management business. You look at the investors and the money managers who do really well over long periods of time. They all own fewer names. They all have very low turnover. They let their companies work for them, and they give them time. And if you're right about, in our case, if we're right about the expanding moat with a culture that supports it, those are companies you should own for decades. And that's where you create wealth.
Hey, Paul, here's a question from a person who has a very positive approach. He said, you mentioned downside capture at, was it 59%? He said, what's the upside capture?
The upside, good question, right? Because sometimes you hear, hey, we get 59% of the downside and we get only 22% of the upside. That's not going to work for you. So our upside capture over time is about 110%. So downside capture 59, upside capture roughly 110%. Those numbers work really well, and they give you compounds rate of return that are probably 5 to 600 or 5 to 6% better than the market.
Okay. Here's another question. What is the proportion of the companies that you hold in the USA compared to the rest of the world? And is there any particular bias in your portfolio or company selection?
Very good question. We tend to be around 50% US, 50% rest of the world. That's a great question because there are managers who call themselves global managers that are 90% invested in the US and have just ridden the bull market in the US over the last 10 years. And to me, that's not completely honest, frankly. To us, when you look at over the next 5 and 10 years, the probabilities that the US outperforms the rest of the world, I think, is slim because we've had such a strong run. So we'd much rather be positioned in names that are not necessarily domiciled or based in the US going forward. But you know what? There are a lot of great companies here, certainly in technology, that you want to own that have a lot of revenues derived outside the US. But in general, we're going to be about 50-50 US, rest of the world.
Okay, here's another question. We know that you're an ex-Australia fund manager, but if an Australian company is on your radar screen, could you talk about it?
I'm sorry, if it's what?
Australian company on your radar screen or has been on your radar screen, would you talk about it?
Actually, one of our favorite names in the portfolio that's been a phenomenal investment for us is CSL, based in Australia, which is a plasma company. And again, it's, we would almost look at it as a picks and shovel kind of idea, working with plasma and kind of reorienting it and using it to kind of heal people in a significant way. We've owned it for probably 7 years. It's been one of our best performers and one of our top holdings for a long period of time.
Great stuff. I think most of us here totally agree with you. It's been a fantastic company. Now, Paul, we are out of time. As always, thanks for joining us. And we really look forward to seeing you in Australia soon. And if that's the case, I'll make sure I'll get you on my TV show. Now, a couple of little things before we go. My pleasure, mate. A couple of things before we go. Make sure I don't miss any points here. If you'd like to learn more about how Aussie investors can gain access to WCM's quality global growth strategy, you can contact us at invest@contango.com.au or via the telephone, that's 0290165397. You can go to the website www.contango.com.au/WCM. Thanks for joining us. And once again, Paul, thanks for coming in from the USA.
Thank you, Peter. Take care.